Welcome to Nasdaq Sector Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Back with me at MarketSite, we have Masood Ghazi. He's a senior analyst with Nasdaq IR Intelligence. We're going to take a quick check on the performance review in the markets, as it has been a pretty volatile week in the markets. Masood, as always, great to have you back with me, and it's been quite the week for traders and investors out there. I mean, take a look at this four-day performance.
What a hectic week, Jill. I mean, up until last Friday, it was all quiet. We were looking at historic low volatility. The VIX came crashing down, and abruptly the trade war tide reversed on Sunday with President Trump's tweet stating that he will reimpose tariffs, or extend the tariffs, I should say, by Friday if a deal is not reached. The initial reaction by the markets is interesting because on Monday, the market started to pair losses, and it almost finished in positive territory. And reason being, investors were assessing whether this was a negotiation tactic or whether trade tensions are actually escalating. And the interpretation was that it was only a negotiation tactic. But as the week progressed, we started to see the markets fall globally, not just the U.S. The U.S. is down approximately 2 to 4% because both sides, their positions started to harden, and China started threatening that they will retaliate and that they are ready for they'd be ready for a trade war. So as such, we've been seeing underperformance. But interesting enough, not in this chart, is we're starting to see the markets pair losses today, as apparently President Xi sent a letter to President Trump stating that, President Xi sent a letter to President Trump, and President Trump started mentioning that potentially there could be a deal on Friday.
Yeah, I mean, it's quite incredible that nothing else moves this market with the exception of the U.S.-China trade deals. I mean, we had healthcare news out yesterday. We have things happening in Iran and North Korea, but the only thing that matters is tomorrow with these trade tariffs. Let's take a look at the Shanghai Composite, our next chart here, and its performance as well. Yes, it has not fared well as of April, but it has been doing pretty well with the exception of the past month.
Yeah, so China's down about 8%. As mentioned earlier, the U.S. markets are down probably 2-3%. And the reason behind the outperformance of U.S. markets is because of what's called the Trump put. Over the last 28 months, President Trump has staked his presidency on the performance of the markets. Every time the markets soften, he would step in to calm the markets. So there's some expectation that there will be a positive outcome from all this, and as such, the U.S. markets have not fallen as much as it probably should have.
Especially with so much optimism baked in. Let's move forward and take a look at the yield curve. I haven't heard too much about it this week with all the trade talks going on.
Yeah, so interesting enough, back in, when was this, end of March, the yield curve started inverting. And when the yield curve inverts, there's concerns about potential recession looming. However, it was short, and usually if it's a prolonged yield curve inversion, there's risk of a recession. Now, enter this week, the 10-year and 3-month here started to head towards inversion once again. So markets are nervous. Bond markets are also signaling that this could cut into growth. Obviously, tariffs are a tax on U.S. consumers and businesses. So investors obviously are concerned from that standpoint.
All right, so should we think about shifting expectations here?
Well, in terms of the Fed, the rate cuts and rate hikes, up until last Friday, it fell below 50% as we got very strong economic data. GDP was up 3.2%. Payrolls, the jobs report was up 260,000. So everything was good. Everything was humming. Even the Fed announced that the markets are, the economy, the state of the economy is good. So we've started to see the odds of a rate hike come down. But interestingly enough, this week, because of the trade tensions, we're starting to see the odds of a rate cut, start to move up again. So we're looking at an odds of rate cut of approximately 60% now. So up from approximately 45% last week to 60%.
I would imagine that we'll see a very dovish Fed through the election, that's for sure. All right, let's take a look at our last chart, S&P 500 quarterly consensus expectations. Seeing a little bit of a shift here going into Q2.
Yeah, so early this year, there was talk of an earnings recession. Both Q1 and Q2 will post negative EPS growth. But the sentiment started to change for Q1 at the very least, as we started to see positive results coming out of U.S. corporates with earnings, and analysts started to revise their earnings higher. However, Q2 is looking a little bit weak, most likely because trade tensions are kicking back in. So the expectation is that first quarter will be good and second quarter will be weak. And some of the themes around earnings are one, China, U.S. economic resilience, Europe being soft, and also with respect to data, there's been margin pressure from high labor costs and also rising raw material costs.
All right, and to wrap up here, what are the things that you're going to be watching over the next couple of weeks? Clearly, trade talks is going to be one of them.
Obviously, trade, that's to your point, has been dominating everything. So over the next few days, expect the markets, as it's tethered to the trade deal, to be reacting to every single piece of news that comes out from the trade deal. And also CPI data is coming on Friday, so a lot of eyes on that as the Fed sets policy also based on price levels.
All right, as always, Masood, thank you so much for joining me.
Thanks, Jill.
And thanks for joining us on Sector Talks. I'm Jill Malantrino, Global Markets Reporter at Nasdaq.